All right. Thank you so much, conference organizers, for including this paper in the program. It's a great pleasure to be here. So today I'm going to talk about mutual fund rounds and liquidity management. So, we talk about bank rounds all the time, and we all know how scary bank rounds can be. But today, the potential for mutual fund rounds simply becomes incredibly relevant because of the huge liquidity mismatch involved in this industry. And that means, after the financial crisis, the mutual fund industry have been increasing rapidly in size. On the liability side, they promise their shareholders daily liquidity, which means they can be subject to daily redemption shocks. But on the asset side, those mutual funds, they have been investing much more in super illiquid stuff, such as junk bonds, emerging market assets, bank loans, even real estate. So given this huge liquidity mismatch, a lot of regulators are super worried about potential bank run-like scenario on mutual funds.
So you have evidence that they're investing in liquidity assets?
Here we go. So, this didn't happen, right? So on December 10th, 2015, the Focus Credit Fund, or Third Avenue, which was one of the largest junk bond funds in the US, shut down redemptions in the middle of severe shareholder runs and FISO losses. And notably, that was the first case since the 1914 Act that a US mutual fund shut down redemptions without getting approval from the US SEC. And after that, we do have more and more examples of mutual fund rounds, like the rounds on many liquid alternative mutual funds in 2015, and severe rounds on UK real estate mutual funds around the event of Brexit. And even more, we do have more and more micro-level evidence which suggests the existence of the first mover advantage in the mutual fund space. And that also consists with a view of mutual fund rounds. But, despite the prominence of this issue, the underlying mechanism for potential mutual fund round story is still not well understood, and a lot of people simply try to deny the existence of mutual fund rounds. Especially mutual fund managers, they try to defend their business by talking about two unique institutional features in this space, two safeguards under the logic of diamond dipping. And number one is flexible end-of-day NAV. And the idea is if you're going to redeem your shares, let's say in the morning at 9 o'clock, you will have to wait until the end of day, until 4 p.m. to get the end-of-day price. And that means if the fund is forced to fire sell anything during that day, you will have to get a lower NAV because the NAV will take into account that price impact and SSL losses. And that means that's going to mitigate your run incentives in the first place. That's safeguard number one. And safeguard number two is liquidity management. And that means mutual fund managers, they do really hard to manage their cash buffers over time. They always make sure they have enough cash to make redemptions, potentially without fire selling their liquid assets. So the question is, if we really take those two unique institutional features, those two safeguards seriously, can there still be rounds on mutual funds? So that's a question of this paper. Of course, the paper answers this question, and the answer tends to be yes. And perhaps surprisingly and ironically, I will show you that, in my word, it is indeed the combination of those two safeguards, the combination of flexible end-of-day NAV and dynamic precautionary liquidity management, which are viewed as safeguards, they will give rise to mutual fund rounds in this world. And rounds can happen even without fundamental shock to the underlying assets. And again, the round mechanism has some important difference from classic bank rounds like diamond dipping. But here I do want to be very upfront. So I'm not going to argue that mutual fund rounds are something that can happen every day. They're not something that can happen for all the mutual funds. So I like mutual funds and I do invest in mutual funds. But I'm going to give one sufficient condition under which mutual fund rounds can potentially happen. And that's going to be because of the illiquidity problem, because of the illiquidity mismatch, the asset prices, they may not be perfectly forward-looking. And that's going to be the key. And importantly, that situation kind of pervasive for many mutual funds today. And that's the punchline of this paper. So before jumping into the details, let me first show you the three most important pillars of this model, hopefully to give you a basic sense what's going on here. Pillar number one is with flexible NAVs, the need for the fund manager to do cash rebuilding over time can generate shareholder runs. So let me be more specific about this. So let's think of a large open-end mutual fund investing in both cash and illiquid assets such as corporate bonds. So today, there is a large redemption going on because the fund has a lot of cash. It can simply pay cash to meet those redemption needs without fire selling illiquid assets. So in this case, there are no fire sales, NAV doesn't change, so nothing bad happens. But tomorrow, after outflows today, the fund is likely to rebuild cash buffer by selling some illiquid assets. And that means there's going to be a predictable decline in NAV tomorrow because of the predictable sales of illiquid assets. And that's going to generate the gap between NAV today, which is higher, and NAV tomorrow, which is lower. And that gap will generate a first move advantage among shareholders, which eventually lead to runs. So that illustrates the first important trade-off of this model, which is a trade-off between current, because if you have a lot of cash buffers, that's going to help you avoid fire sales today. But tomorrow, the need for you to rebuild cash buffer can potentially generate runs. So now you may have a question. You may ask, if cash rebuilding can generate runs and runs are bad, why we have to do cash rebuilding? So to answer that question, we can look at the fully dynamic model, and there will be new trade-off there. Specifically, like I said, if you rebuild your cash buffer more rapidly tomorrow, that's going to generate runs, which are bad. But if you do not rebuild your cash buffer, that means the day after tomorrow, so on day 2, you have less cash, so you are more likely to suffer another round of fire sales, which are also bad. So this gives rise to the dynamic trade-off of this model, which is a trade-off between current rounds when you rebuild your cash buffer rapidly and future fire sales when you rebuild the cash buffer less rapidly. And this dynamic trade-off will eventually pin down the optimal speed of cash rebuilding over time, and that will in turn pin down shareholders' run behavior in this model. But this is not the end of the story. There will be another time inconsistency problem, which makes the trade-off even worse, and that's going to make run problems inevitable. So what's that? As you can remember, basically, when current run risks are high, the fund manager may want to pre-commit to a less rapid cash rebuilding policy today. So the fund manager may say, hey, I'm not going to rebuild my cash buffer tomorrow. And shareholders will say, oh, that's good, so we're not going to run. But remember, that will never happen in equilibrium, because in equilibrium, when we enter tomorrow, all the run costs today will be sunk. And that means the fund manager will be very tempted to change her mind and choose a more rapid cash rebuilding policy to better prevent future fire sales, but just forget about current rounds. Of course, the shareholders are smart people. They can anticipate that, so they anyways run in the first place. And that means without a commitment device, it could be super hard for the fund manager to credibly announce a less rapid cash rebuilding policy, so it'd be really hard to prevent runs in the first place. All right, so let me jump into this model. So some details, but not too much. So we'll just kind of redo those three pillars in this formal framework and give you a better sense of what's going on here. So we have a discrete time, fully dynamic model, no time discount, a single large open-end mutual fund investing in both cash and illiquid assets. So XT denotes the amount of cash, AT unit of illiquid assets, and NT is population of shareholders. So for simplicity, I simply assume that the return, so the fundamental price for those illiquid assets will be R. So there is no fundamental risk, no variation in returns, no interim cash flow, but because they are illiquid, so if you are going to sell, then especially at short notice, it's going to be price impact, and that means the selling price PT will be lower than the fundamental price R. So I will be more specific about that later on. So now I'm going to introduce the two important features of this model, two important institutional features, flexible NAV and fund liquidity management. So flexible NAV means at the end of the day, fund NAV will take into account all the within day price impact or the wasting the asset sale losses. And that means because we only have one open mutual fund here, if no asset are being sold by these funds, NAV will not change. So it's simply the sum of your cash and liquid assets divided by total population of shareholders. But if any assets are sold during the day, the end of the NAV will be lower because when you sell 80 minus 80 plus 1 liquid assets, you only sell that at the selling price PT, which is lower than the fundamental price R, which means you can only raise this amount of cash. So NAV will be lower accordingly. So this is the key difference from Diamond debate, because in Diamond debate, as long as the bank is still solvent, the bank has always give the depositors the fixed deposit value. So the fixed deposit value will never change as long as the bank is solvent. But here is a different story because as long as the funds sell anything, the end of day NAV will be different. Second feature, liquidity management. So here I'm going to simply assume that the fund manager will minimize total expected asset sales over time. So this is only a mild assumption because the sort of capture the optimal contract design between fund manager and shareholders. Because in this world, as long as the fund manager sells less, he will get more. So this means ex ante, there is no agency friction between fund manager and shareholders. Anything bad happens, it's not coming from an agency friction here. But we do have an important friction here, which is liquidity mismatch, like I mentioned earlier. So on the liability side, we can have persistent redemption shocks, but on the asset side, because of liquidity problems, it's going to be price impact, and market price may not be perfectly forward-looking. And these assumptions are pretty pervasive today. All right, so let me first talk about liability side. So as I said, it's a dynamic model, so we have different stages, and each stage consists of 2 dates, even dates and late dates. So before each stage, there will be a shock hitting the economy, so I would call that redemption shock. With probably pi, the gain will end. So you can think of that end of gain event as a good event in which you have a lot of inflows, the fundamentals are always good, nothing to be worried about. But with probably 1 minus pi, the gain will continue, and there will be projected redemptions. You have to worry about those redemptions. Specifically, if the gain continues, there will be 2 groups of shareholders getting awake. So they have to consume and redeem their shares. There's another group of sleepy shareholders. So they do nothing in the current stage, but they may become awake in future stages. And this captures the idea that mutual fund investors, they do not pay close attention to the portfolio, so they only adjust the portfolio when they're subject to consumption shocks. And that basically means we have to worry about current redemptions. We also have to worry about future redemptions. And that's going to give the fund manager the motive to do cash management over time. And percent redemptions here, they do not suggest rounds per se. But what about rounds? What about rounds in this model? Because more specifically talking about difference between early and late guys, you can just think about early and late guys in Diamond debate world. Early guys, so they always consume and redeem on even dates. They don't have real choice. But late guys, even though they prefer to consume on late date, they can choose to redeem on early date. So if they choose to redeem on early date, on even dates, I say a late shareholder runs the fund. So that's a pretty similar definition of round like that in Diamond debate. And the idea of theta here basically captures, this is an exogenous parameter, this captures the propensity to run by those late shareholders. So this doesn't really matter for the model mechanism because you can choose whatever value you like between 0 and 1 here. So when this is smaller, it just suggests those late shareholders are less likely to run. But what's really important here is, again, different from Diamond debate. When those shareholders are going to run, they will never get a fixed value. They will always get the endogenously determined NAV today. And likewise, they will also get the endogenously determined value tomorrow if they choose to stay. All right, so now let me switch to the asset side, talking about the asset price impact. So here I'm just going to assume that the price impact will be time varying and not perfectly forward-looking. And that means right after the shock, the selling price will be super low. After 1 day, the price will rebound a little bit, but still lower than the fundamental. If there's another round of shock hitting the economy, the price will drop again and then rebound again. So in the model I have, in the paper, I have formal micro foundation, the math for that, but the idea is quite intuitive. It just captures the idea of slow-moving capital in liquid asset markets. And the idea is right after the outflow shock, basically, there are only a few liquidity providers available. So it could be really hard for the fund manager to find a good price. But if she can wait a little bit until the next date, there will be more liquidity providers stepping into the market, so that's going to be much easier for her to find a higher price. But the price is not perfectly forward-looking in the sense that if the fund manager chooses to actively sell liquid assets to rebuild cash buffer, that's not going to be taken into account in the price today. So that's crucial because, number one, this time-varying price impact will give rise to fund managers' motive for liquidity management. Because the selling price on even dates is super low, the fund manager may want to voluntarily sell some liquid assets on all dates to rebuild cash buffer to prevent potentially fire sales on those even dates. But on the other hand, those prices are not low enough because they do not potentially take into account those future asset sales. And that's going to give shareholders incentives to run potentially. All right, so in this model, we have two types of asset sales. Number one is forced asset sales, and that means at the beginning of today, so if you do not have enough cash buffer to meet redemption needs, you'll be forced to raise cash by selling your assets at potentially fire sale place. And at the end of the day, NAV will be lower, and that's going to pin down the amount of forced asset sales. And we also have active asset sales, like I said, so that corresponds to fund liquidity management. So in addition to meeting your redemption needs passively, you can also sell liquid assets any day. And again, the end of the NAV will take that into account. But here I'm going to argue that although in principle, the fund manager can rebuild cash buffer every day, so he can actively sell assets every day, but in any generic equilibrium, she will only do that on all dates, but never on even dates. So this is quite intuitive because all the purpose for the fund to manage the cash buffer is to avoid extremely costly fire sales on those even dates. So it never makes sense for her to voluntarily do so. And that means in what follows, I can just focus on S1, so the amount of active asset sales on odd dates as a single choice variable for the fund manager. All right, so this is what I have in this model. It's a quite simple model, but it's rich enough for me to cover a lot of things which hasn't been talked about in classic bank run models. So here, like I said, I'm basically going to redo those three pillars within this framework very briefly, and just to give you a better sense of what's going on here. So pillar number one, like I said, that means predictable cash rebuilding can generate runs, and more cash rebuilding can generate more runs. And depending on how much cash you have initially, so strategic interactions among shareholders can be subtly different, but the results are always universal here. So let's talk about the first case in which you have a lot of cash to start. And this means the fund has enough cash to meet project redemptions both today and tomorrow. This is interesting because in this case, without cash rebuilding, there will be simply no strategic interaction among shareholders at all. So look at those stars. Those little stars are shareholders. So when they are going to run, basically, we have effectively more early shareholders today, fewer late shareholders tomorrow, because you always have enough cash to meet redemptions for both early and late shareholders. So in this case, you're not going to sell your liquid assets in any case. And that means NAV 0 will not change, NAV tomorrow will not change, so there will be no strategic interactions among shareholders at all. But if the fund manager chooses to rebuild its cash buffer tomorrow, that's going to imply a predictable sales of liquid assets and a predictable decline in NAV tomorrow. And that gap will generate a first mover advantage among shareholders, which eventually lead to runs. So this is case number one. Case number two, you start with so little cash. So this is perhaps more interesting because this is a case in which the safeguards comes in. In this case, you don't have enough cash to meet even the redemption needs today, and that means you will be forced to fire sell your illiquid assets today. In this case, remember, when shareholders are going to run, effectively, we have more shareholders tomorrow, fewer shareholders, more shareholders today, fewer shareholders tomorrow. But because the selling price today is super low, that means the fund has to make more redemptions today when the selling price is super low. And that means the fund manager has to sell even more to meet those redemption needs. And that means NAV today will decline even faster than NAV tomorrow does. So look at this again. When shareholders are going to run, NAV today declines even faster than NAV tomorrow. And that suggests a natural strategic substability in this case. Because when other shareholders are going to run, it makes you less willing to run. But again, when the fund manager is running out of cash, she's going to choose an even more rapid cash rebuilding policy tomorrow to better prevent future fire sales. And that's going to restore a strong first mover advantage. All right, so now we're able to talk about the difference from diamond better because we talk about bank runs, we talk about fixed value deposit, and talk about sequential service constraint. But here's a different story because we have flexible NAV, we have cash rebuilding. And without cash rebuilding, if you have a lot of cash, there will be no strategic interaction at all. If you have little cash, when other shareholders are going to run, you are less likely to run. But when the fund manager is running out of cash, she's going to choose a rapid cash rebuilding policy, and that's going to imply a predictable decline in NAV tomorrow, and that's going to restore a first mover advantage in this mutual fund space. And that basically speaks to a dynamic interaction between the fund manager and shareholders. And this dynamic interaction is sort of absent in classic bank run models in which they basically focus on coordination failures of shareholders themselves. All right, so very briefly about the dynamic model here, because when the fund manager chooses the cash rebuilding policy, that's going to change NAV today, NAV tomorrow, and that's going to ping down the amount of forced asset sales, and those will be captured by cover run risks. But on the other hand, those numbers will also determine how much illiquid assets and cash you can bring to the next stage. So due to the continuous value of this gain, that's going to ping down future fire sale risks. So as you can imagine, basically, if the gain is more likely to continue, or if you expect lower cash tomorrow, so that means future fire sales will be higher. And the trade-off is pretty straightforward here, because if future fire sale risks are high, you may want to rebuild the cash buffer more rapidly. Otherwise, you may want to rebuild the cash buffer less rapidly. But what's subtle here is the time inconsistency problem here, because when the fund chooses its cash rebuilding policy, it's already day one. And when the shareholders think about their run decisions, that's still day zero. And that means the shareholders will take fund managers' future cash rebuilding policy into account. They always anticipate that time inconsistency problem, so they always run in the first place. So at the end of the day, the model basically suggests mutual fund is not run free due to the liquidity mismatch in this space. And when shareholders are more likely to run, that's going to generate more severe extended fire sale losses. And of course, if you introduce a commitment device, that's going to help. But unfortunately, for mutual funds, we simply don't have such commitment device. In hedge funds, probably we do, because they have something called drawdown control. And that's very much like a commitment device, which allows them not to change their liquid management policy day by day. But again, for mutual funds, it's a different story. So in the model, I do have a lot of extensions to potentially take into account fund-level policies, like I mentioned here, in-kind redemption, redemption fees, redemption restrictions, a lot of other things. What's really interesting here is when we think about policies, we really have to take the dynamic trade-off between runs and liquidity management into account. Otherwise, it may even lead to more fire sale losses. For example, here is my favorite example here about in-kind redemption. Because in this case, in-kind redemption means instead of giving your shareholders cash, you can give them the underlying basket of assets. And what's nice about that is, in this case, because all the shareholders will get the underlying basket, they will never run. And the fund will also stop managing cash because there's no point for them to have cash anymore. What's interesting here is, under some circumstance, the shareholders, they will sell the assets by themselves because they need to come soon. And that means it could be even more extensive fire sale losses. And the key here is in-kind redemption basically give up the benefit of liquidity management. And that really suggests that we have to take the dynamic interaction of liquidity management and fund rounds into account. And that suggests, for ETFs, because ETFs, they do have in-kind redemption between the fund sponsors and their author participants. And due to that problem, although, we may not run ETFs, but those author participants may file sell their liquid assets by themselves. And that's something I'm exploring in another paper with my colleague. All right, so at the end of the day, this model suggests mutual funds are not run free despite flexible NAV and optimal liquidity management. But not all the mutual funds are subject to runs. What's really important here is liquidity mismatch, and that implies asset prices and not perfectly forward-looking. And that really speaks to a new mechanism here, which is a dynamic interdependence of fund liquidity management and shareholder runs. Thank you very much.